Good evening, everybody. Thank you very much for coming on this rather sort of dull and slightly cold Midlands evening. It's Christmas time. Doesn't feel particularly summery at the moment, but hopefully the news that we have to share with you tonight will make you warm up a little bit. And I just want to welcome everybody that's online too. This is being recorded and sent out on Zoom, so welcome to everybody who's online. It's lovely to have everybody with us. So, it's the end of 2025. We look forward to 2026. And the real question is whether we can look forward to 2026 with enthusiasm or a little bit of trepidation. So the other day we were talking in the office, we were sitting having lunch and we were chatting, and as all good conversations go, there was some music involved, and we started discussing what the outlook looked like for 2026, and it basically came down to a music theme, and we had to decide if we were on the road to hell from Chris Rea. So all these songs should be in everybody's music collection. I mean, they're classics, and if they're not in your music collection, you need to hop onto iTunes and go and download them. So hopefully we're not on the road to hell, but you never can tell. I think earlier in this year we might have implied to you that we were on the road to nowhere by Talking Heads. Last week we were in Joburg. That's where the streets have no name, unfortunately, or you can't see the names because the grass is so high. Hopefully we're heading to the bright side of the road, but unfortunately I'm not sure we're quite as enthusiastic as to say that we're on the road to heaven. But we'll take the bright side of the road, and hopefully over the next couple of minutes I will persuade you or convince you that maybe we are on the bright side of the road. So as I said, if you don't have all those songs in your music collection, go and download them and play Bright Side of the Road often. Cheer yourself up. Right, I think it's just worth reflecting for a second on where we have come from this year. If you look at the chart on the left, it really just shows the performance of some of the major markets this year. And yes, you will notice that the dark blue line is at the top and the dark blue line is SA. So if I'd said to you at the start of the year, SA was going to be one of the better performing markets around the world this year, we would have laughed at each other, and we would have probably laughed at that too. And I think there's a lesson in there that I'll come back to later in the presentation about trying to be too nimble in markets and rather just letting markets do what they do and staying there for the long course, because you never quite know when markets are going to find their mojo or take off or do whatever. And certainly you can see the reaction in April there when we had Liberation Day and the reaction thereafter. But if you actually look on the right-hand chart, you can see that actually while we have been one of the best performing markets, it's actually been very concentrated. So we can't take all the credit. Obviously this year has been a stellar year for gold, for platinum, and those shares on the market have done really, really well. The rest of the market hasn't done maybe quite so well, but 15 to 20% returns is nothing to be sneezed at. And actually 15 to 20% returns are very much in line with what US, UK markets have done this year. So it has been all about the miners this year, but don't feel that the rest of the market hasn't done its thing. But some of the SA market has been more challenging, there's no doubt about it. And hopefully by the time we end this presentation, we'll convince you that the outlook is actually changing for that end of the market, and there's something a little bit more brighter to look forward to next year. So I want to start off by really just dealing with two elements of the economy that are not particularly big from a GDP point of view, and that's mining and agriculture. But they are important from a GDP point of view because they're quite variable sectors, and if they're performing, they contribute positively to GDP, and if they're not really performing, then they subtract. And I suppose more often than not in the last couple of years, they've maybe been a net detractor from GDP rather than an addition. But we do think that is slightly starting to change. So if we just go onto sort of mining, I suppose, it's really the benefits of shifting politics. And how often have we spoken this year about shifting politics and global issues and the unpredictability of what's happening in America at the moment? I suppose it's all pretty front and center of our minds because of the way the US has treated us over the G20 and continues to treat us. But really, I suppose what's happened, we all know that the gold price is sort of $4,000. I suppose the question for us as investors is that going to be sustainable? Is it actually going to last? Is the gold price going to be back at $2,000 next year? And then we have all the benefits that we've had this year evaporate just as quickly. And I think really the message from our side and what we look at is that chart on the left, which shows gold as a percent of foreign exchange reserves. So every country has foreign exchange reserves. Some of it's invested in dollars, some of it's invested in gold. But when Russia invaded Ukraine, quite rightly, foreign exchange reserves were frozen. Russia was kicked out of the SWIFT system. But essentially, I suppose the composition of their reserves and their dependence on some of the global sort of payment systems made them quite vulnerable. And they obviously, quite a lot of countries looked at that and said, well, we don't really want to be vulnerable. We don't really want other countries to really be, to be at the beck and call of other countries. And there was a general trend to start diversifying reserves out of US dollars and into other assets, of which one of them is gold. Obviously, that trend has accelerated enormously this year because the US has become much more unreliable. You're never quite sure if you get called into the Oval Office whether you're going to get a dressing down, whether you're going to come out alive, what's going to happen in there. And having the US having been a very predictable ally and maybe a very stable friend is suddenly not so much. And the last thing that a lot of countries want now is to find themselves on the wrong side of Trump for whatever reason, and then suddenly to find that their foreign exchange reserves are frozen or whatever the case is. So countries are diversifying quite rapidly. 50% of foreign exchange reserves are still in US dollars, and so there's a lot more diversification that still has to happen, and we don't necessarily think that means the gold price is going to $6,000 or $7,000, but we do think that a level of $4,000 is more than sustainable, and that essentially underpins the mining environment that we have here. You can see what's happened to precious metals prices in the middle. The red vertical line is really just the start of this year. So gold prices have been rising for a couple of years, but what's really encouraging from our point of view too is the recovery in platinum or PGM prices, platinum, palladium and rhodium. And obviously that's very important for us. So all these benefits are now flowing through down to the economy. You can see that in the terms of trade. The terms of trade is a measure really of the competitiveness of our exports relative to our imports. You can see how that's improved substantially over the last, 2 or 3 years, but it's at the most competitive it has been for essentially 15 years. And that is then feeding through to a stable exchange rate. And if you want to see the benefits of mining or this mining boom, higher gold prices, higher platinum prices, you just had to look back at the budget a couple of weeks ago, and SARS had collected 5 billion rand more in tax from mining royalties than they had expected to. So when we talk about the benefits of commodities flowing through, it's nice to see those benefits coming through. So mining still has its challenges, there's no doubt about that, but we're quite confident that mining is actually in for a better couple of years, having had quite a tough few years. And the same really applies to agriculture. I'm sure there are a few farmers and ex-farmers in the room tonight, and we're probably having too much rain at the moment to keep the farmers happy, and probably everybody feels we're having too much rain. But what's really important from a GDP point of view is really whether we're growing or contracting. And the maize crop for this current season, at this stage, it does change obviously every sort of month or 6 weeks it gets revised and updated. But at this stage, the maize crop looks like it's going to be very close to another record maize crop. And for all the talk about tariffs from the US and the tariffs that were imposed from America, our citrus exports are still up 22% this year. So the tariffs that were imposed by the Trump administration have actually been largely we haven't really felt the impact. About 3 weeks ago now, the US actually revised all the tariffs on agricultural inputs. I think they suddenly realized that Americans were paying a little bit more for their food, and there were complaints. Americans weren't having their freshly squeezed orange juice for breakfast in the morning, which I think they feel is a constitutional right over there to have their orange juice. And so it's just, it just goes to show that we said at the time that some of these tariffs were rather ill-conceived, they were hastily put in place. And I suppose the administration is coming to the same sort of realization. But for all the doom and gloom that the press espoused in the middle of the year when there was a lot of uncertainty, our citrus industry has really shrugged it off. And even if you look at sentiment across the whole of the agricultural sort of industry, farming industry, it's not at a record high, but it's not far from a record high, and it's really just influenced by the tariffs. So the last reading here was actually before the tariffs were rescinded, and secondly by foot and mouth. And it's obviously very encouraging to see government starting to roll out a vaccine for foot and mouth. So as I said, these two sectors are quite variable. They do. When we had GDP data earlier in the week, these two sectors contributed positively, which was nice, but they can be quite variable. So when we look at GDP next year and we decide, is there going to be some momentum or not, it's quite important to have an opinion on these sectors, because even though they're not that big, they do employ a lot of people, and they do then filter down through the economy. If you look at tractor sales or machinery sales, you can see that there's a lot of activity in the farming industry, and so that's where it does sort of feed down through to the rest of the economy. So let's move to the budget, because this is really where it starts to get very interesting. Well, it's interesting for us. I hope it's interesting for you. I'm not going to read all the text in the little box, but you can just read that quickly for yourselves. But this budget was really a watershed moment. You know, how often have we stood here and said or written an intuition about the budget, and you know, the comment generally is, it's not bad under the circumstances. It can be so much better, but you know, it's a good effort. We haven't got much wiggle room to work with, but we always keep on kicking the can down the road. This is the first time we've had a medium-term budget where there's really visible progress on some of the key issues that government is trying to achieve. And you can really see, I think, in this budget, the impact of the GNU coming through, the fact that there's more collaboration in the budget. It's not just ANC policy that comes through, and there's much more debate about how the money is spent and what to do about it. So just in brief, there's been a 20 billion rand surplus tax revenue that they didn't expect to collect. So well done to everybody in the room if you've paid your taxes. The government is thanking you. But equally importantly, and I'm going to go on to this on the next slide, that's led to a stabilization in our debt. It's led to a lower borrowing requirement. I want to see if you guys are as wide awake as the crowd this morning, but you'll probably be amazed to know that the government borrows 4 billion rand every week. Oh, there was hardly a reaction. You guys are, this morning I got a big gasp of horror. But that borrowing requirement has now been lowered to 3.5 billion. Now, 3.5 billion still sounds like a lot of money. It is still a lot of money. But the fact is that for once, probably for the first time in, not living memory because we're quite old, but in recent memory, government's actually revising down how much money they're borrowing every week as opposed to revising up how much money they're borrowing every week. There are some expenditure savings. Government is targeting ghost employees. They're doing some of the things that the GNU really wanted for a long time. And really importantly, they're reinvesting some of those savings back into infrastructure. So everybody knows that our infrastructure is crumbling. It's lovely to see them working on the N3. It would be even lovelier when it's done. But we haven't had that kind of infrastructure development really since the World Cup in this country. And it's really nice to see government starting to reprioritize some of the money and put it back into infrastructure. So if you just look at freight volumes on the right-hand side, you can see on the red line, everybody in this room will probably feel an affinity to that red line because that's road, that's basically the amount of volume of freight that's transported by road. And if you drive on the N3, you can see it because it's just one long line of trucks every single day. But the blue line is the amount of freight that's carried by rail. And you can see it obviously declined steadily, but in the last 2 years, it's at least stabilized. Last month, we had a meeting with one of the coal mining companies. They were just commenting that last year, Transnet railed 52 million tons of coal to Richards Bay. This year so far, well, up until the end of the end of September, they had done 54 million tons. And in October, if you annualize the run rate, they did 64 million tons. That's the best performance that Transnet has delivered in probably 10 or 15 years. So when we talk about these reforms coming through and we talk about Transnet getting back on track, It's really nice to see that some of those things, we talk about it often. It's lovely to have the private sector and mining companies confirming that what we see happening at a government level is really happening on the ground too. Probably one of the biggest sticking points in our economy, and one of the reasons why we're not growing fast enough is gross fixed capital formation. That's basically investment. You can see just how low the blue line is there. That's public sector. The red line is private sector. It's one of the big issues that there's not enough investment. But actually, when GDP data came out last Tuesday or 2 days ago, there was actually that was actually one of the bright spots of this quarter. And so maybe we're starting to see the very first green shoots of some investment in the economy. But apart from all of that, all the good news around the debt, which I'm going to talk about in a second, the really exciting news in the budget was the move to a lower inflation target. And I'm going to spend a little bit of time at the end of the presentation talking about that, because that's really the big opportunity for all of us in the room to benefit from this once-off move in the inflation target. And I'm going to spend some time talking about that. But let's just talk about just finish up on the budget. A primary budget surplus is your revenue less your expenditure before you pay your interest on your debt. And this is going to be the third year in a row where we run a primary budget surplus. We haven't run a primary budget surplus since 2009. You can see just how dire the situation was in those middle years, and obviously the COVID year is the really big negative year there. So this is just the primary budget balance. It doesn't include the full budget balance when you take interest payments into account. But the fact that government has now moved to running a primary surplus is a massive leap forward. It basically means that essentially your operating expenditure is being covered by your tax revenue, and it's just your interest payments that are obviously adding to it. But for the third year in a row, we will have a primary surplus, and the momentum is building. Now, if you're very eagle-eyed, I'm going to test you on this a little bit later. If you're very eagle-eyed, you will notice on that middle chart that the blue line is the medium-term budget, which was 2 weeks ago, and the red line is the budget in February. And if you look at that chart, you will say, but surely that's not correct, because the blue line is worse than the red line. In other words, debt to GDP is being pushed out. That's actually quite right. What's really important to note in that middle chart is that this is the fiscal year ending in March 2026 for the government, that debt to GDP will peak. And the only reason why that line has been pushed out is because of the new inflation target that's been put in, and so government has revised down its GDP growth forecasts, like nominal GDP growth. So they used an inflation rate of 4.5% and added some nominal growth to that. Now they're using an inflation rate of 3% and adding some nominal growth to that. So they've brought down their GDP growth forecasts, and that unfortunately changes the denominator and makes that line go out. But that's not a bad reason for that line to shift out. Essentially, the government is being a lot more conservative, and it's a very short-term price to pay for a much longer-term benefit. But if you look at the chart on the right, this is what's really exciting, is that our debt servicing cost, the amount of money we have to pay in interest every year, is peaking this year as a percent of revenue. Next year, it's going to start falling. And if you just look at the chart over the last essentially 10 years, that solid blue line, every single time we've had a budget, that line has just been climbing, and it hasn't been climbing steadily. It's been climbing like a rocket. So you've got to give government credit for the fact that we're now in a situation where that is actually seriously peaking and is going to start falling next year. And I think that's why the market really is so excited about this budget, because it's not saying we are going to get there. If you listen to the UK budget a couple of weeks ago, I think it was last week, they had a lot of forecasts, but a lot of their tax increase and things were all pushed back to 2030 and 2031. This is not what our government is doing. They're actually essentially taking the pain now, and we're looking at the next year and 18 months' time and seeing an improvement. We're not making assumptions about 5 or 6 years down the line and saying it's going to improve then. And I think that's where the really big change has come in this budget. So the rest of the presentation really I want to talk about inflation targeting, because this is as I said before, this is the really big opportunity for us as investors over the next sort of 2 to 3 years. So you can just see on the chart on the left-hand side there that our inflation targeting regime, is out of line with all our peer group. And if you have an inflation target, so our inflation targeting regime basically says the target's 4.5%, and there's a tolerance band between 3 and 6%. And you can see most countries have either a target of 3% or 2%, with a 1% sort of tolerance either side of that. But what you say to the world when you have a higher inflation target is that obviously your inflation is going to be higher, but what that means is that your interest rates are going to be higher, your currency is going to be weaker because your currency would depreciate by the difference in inflation between two currencies. So you're actually almost sending out this negative message the whole time that, we have high inflation, we're going to have high interest rates, we're going to have a weaker currency. That's not a sort of hanging a big welcome sign up on your front door and saying, come and invest in South Africa. And so the Reserve Bank is really using this opportunity when inflation's come right down, the oil prices are very contained, the rand is getting stronger. It's seizing the moment to say this is the time where we need to change the inflation target, make it 3% with a 1% tolerance either side, so essentially a range between 2 and 4%, and to drive that home over the next couple of years. And the benefits of doing that are really enormous. You can just see from the chart on the right, if you have a 4.5% inflation rate, your prices double every 16 years. If you have a 3% inflation rate, your prices only double every 24 years. And that's obviously a massive benefit to everybody in terms of cost of living. So our inflation rate, the chart on the left, you could just have a look at that. It was very volatile. We actually introduced inflation targeting in 2001. It's a long time ago, 25 years ago now. And in those first couple of years, it took quite a long time to really get hold because, first of all, we had 9/11. There was quite a lot of volatility around that, if you remember that. Then we had a bit of a recession going into sort of 2003. And then in 2004, 2005, we won the World Cup bid. It also coincided with China growing very strongly before they hosted the Beijing Olympics in 2008. And commodity prices went crazy, and the whole world experienced very strong inflation in that sort of 2005, 2008 period. And then everything came crashing back down in the global financial crisis. But really since 2009, our inflation rate has been much more stable. It's been anchored in this 3 to 6% level, except for the last sort of 2 years, which is this global inflationary bubble that we've all had since COVID. But the real thing to focus on here is what happened to interest rates as inflation expectations started to come down. So as people started to believe that inflation was going to be 4, 5, 6% instead of the 12, 13, 14% that we'd been used to in the 90s and the early 2000s, interest rates became structurally lower. So any of you here tonight who would have had a home loan in the 90s or when you guys were sort of growing up, you will probably remember interest rates of between 15 and 20%. Exceptionally high. But as inflation came down, interest rates dropped materially. You can see here over that first decade of the century, interest rates really came down, and then they were pretty stable for a long time, except for this period at the end, which is really the COVID impact. And that's where the benefit to us as investors comes from over the next couple of years. Because if we look at the real repo rate, so if we take the repo rate and we subtract inflation from it, then we get to a real repo rate at the moment of about 4%. It's a little bit lower than 4%, but there or thereabouts. And you can see from the chart that on an inflation-adjusted basis, interest rates are as high as they've been for 25 years. So if people say it's tough out there and the economy is not doing well, they're actually right, because interest rates are very high relative to history, and the Reserve Bank is doing this on purpose because one of the consequences of inflation targeting is maybe slightly higher interest rates in the short term for a much bigger benefit down the line. So it's essentially a bit of delayed gratification coming through. But if we then look at the chart on the right and say, well, the inflation target is really 4.5%. That's the middle of the band that we've been operating on for the last 25 years. So if we take the repo rate and we subtract 4.5% being the hypothetical inflation rate, inflation target, then we essentially get to a real rate, and the average of that over the last 15 years has been 1.75%. So the Reserve Bank does target a real interest rate of about 1.75, but let's just round it up to 2%. So what that really means is that we have an inflation rate of 3%, we have a real interest rate of 2%, and so the repo rate should be 5% going forward. Structurally around 5%. It's 6.75 at the moment. So interest rates have the potential to fall by 2% over the next couple of years, but structurally low, not just a cyclical change in interest rates, and they will go up as things start to heat up, but that's a permanent move lower in interest rates. And when you have a permanent move lower in interest rates, that's when you really get some exciting moves in financial markets. So this is a very simple chart. It just really plots the relationship between inflation on the one hand and valuations on the other. And it's a very intuitive thing. If you have high inflation, you have high interest rates. As inflation comes down, your interest rates fall. And because interest rates are a variable in how you value stocks and bonds and property, as your interest rates fall, the valuations go up. So it's a very intuitive relationship. As inflation falls, your valuations go higher. And this is just empirical data from South Africa and from the US, just to show you that we're not cheating and we're just using data to suit ourselves. But you can see very clearly that there's a very consistent relationship, that as inflation comes down, you tend to get higher valuations on your investments because you have a structurally low interest rate environment around that. So, in our marketing brochures, we actually have this little table, and it really summarizes the capital growth expectations from different asset classes and what we think you should expect from your investments over a cycle. Now, this is just the capital growth element. It doesn't include the income. But if you have cash, you don't get any capital growth. We all know that. If you hold bonds, you can get some capital growth, but it depends whether you hold it to maturity or not. If you buy a bond at issue and you hold it to maturity, you don't get a huge amount of capital growth. Property, we think you should get inflation plus 1 to 2%. And on equities, you should get inflation plus 4 to 6%. But if you actually look at the chart on the right-hand side there, over the last 30 years, our democratic era, and think of all the challenges that the last 30 years has provided, there's been some good times, but there's certainly been some bad times. Equities and property have actually delivered nominal returns of about 14%. But after inflation, they've done about 8%, and bonds have done about 6%. And I think the real challenge of inflation targeting, and if the Reserve Bank is successful in implementing it, is that it's very, very positive for bonds, for property, and for equities. It is not positive for cash. Cash investors basically lose out because your interest rates are going to fall, and you're going to get less and less income on your cash. And at the same time, because interest rates are falling, your valuations are rising for bonds, for property, for equities, and they do very well. So it's really a call to arms in some ways, this presentation, and that if we are going to achieve this over the next 3 years, and it probably will take 3 years for the Reserve Bank to achieve this, it's not going to happen overnight, then the last thing you want to be doing in the next couple of years is being too conservative. So I just really want to explain the mechanics of a re-rating or a valuation change. What do I really mean by valuation change? This is quite a busy slide, but you don't have to look at all the numbers. I'll explain it quickly. So this is Standard Bank. It's just you can use any bank. You can use a dozen different companies for this example. But if you look at the table on the left, it basically shows you what Standard Bank's profits have done and dividends have done over the last sort of 10 years. And the little line in red there, the 5-year CAGR, just shows that Standard Bank has grown its earnings, its profits by 8.8% a year, and its dividends by 8.7% a year over the last 5 years. That's very solid, nothing spectacular, but it's okay. We haven't had the best 5 years, so we'll take it. If you look forward, the little box below that, based on current expectations, Standard Bank is expected to grow its profits at about 9.9% over the next 3 years, and the dividend by a similar amount. And so you can see that there's not much difference. I mean, yes, there might be a % difference, but it's really not vastly different. So Standard Bank is pretty much expected to deliver roughly the same level of growth going forward as it has done for the last 5 or 6 years. You can see the share price chart of Standard Bank, that's the first chart on the left there. So back in 2000, Standard Bank was about 40 Rand a share. If you have a very good memory, you will remember in 1998, there was the Russian crisis. Standard Bank had actually lent Russia a lot of money, about $100 million. That was then written off. Standard Bank fell, I think, from 40 or 45 Rand a share to 28 Rand a share. The market was in uproar. It was a calamity. And now that looks like it's not even a blip on the chart. But if you notice, if you look at the chart, and I'll come back to it in a second, you'll notice that Standard Bank peaked at about 230 Rand a share back in 2018. That was when we had that period called Ramaphoria, which we now call Ramaphoria, where everybody got very excited when Cyril was appointed leader, and everybody thought that our fortunes were going to change overnight. And then after 4 months, we all realized that we needed a dose of reality, and nothing much had changed. But if you just look at the chart on the right-hand side here, generally the share price and the profits follow each other over time. And that's absolutely intuitive, and that's exactly why you buy shares, because as the profits rise, the share price rises, and so your wealth grows. But you'll see that there's a gap between those two lines more recently. And that's really because the valuation has deteriorated. So Standard Bank was, really trading at a sort of 11 times valuation, even a 12 times valuation. If you look at the chart in the middle, it's currently trading at a 9.6 times valuation. So if we look ahead and we say Standard Bank's going to deliver the earnings growth that the market says it's going to, and so profits in 3 years' time are going to be 36 Rand a share, and we just assume that Standard Bank is not going to change its valuation, the market's going to keep on doing exactly what it's done, then the future price will be 343 Rand at the end of December 2027. The dividends will be another 54 Rand on top of that, and you will have a return of 47% over the 3-year period. That's nothing to be sneezed at. That's a very good return, 15-16% a year. That's certainly not going to make you poor. But if we are correct in saying that the opportunity for investors is that inflation's coming down, interest rates are going to come down, and valuations are going to be structurally higher, then if Standard Bank's valuation goes either to a 10.5 times or a 12 times, and 12 times is not particularly aggressive, it's traded at 12 times on many, many occasions over the last 25 years, then you can suddenly see how the return changes. And this is not, Standard Bank hasn't done a single thing differently here. It hasn't made a single cent extra of profit. We're not assuming in this exercise that just because interest rates are coming down, that Standard Bank's actually going to make more profit. That will happen. So these numbers are actually conservative, because if they make more profit, then these numbers obviously change exponentially. But I didn't want to be accused of window dressing here or anything. But if you just have a valuation change, then your future share price can go from 340 Rand a share to 430 Rand a share. And that's really the opportunity that we think is coming for investors over the next 3 years, coupled with the fact that actually government is getting its house in order, and they're laying the groundwork for slightly faster growth. So again, this is really the call to arms to say don't be too conservative, because these opportunities don't really come around very often. I can't say they happen once in a lifetime, because this is the second time we've introduced inflation targeting or changed the inflation target, so it's twice in my lifetime. But they are sort of once-off structural things that you have to be able to benefit from, because they don't repeat themselves too often. So unfortunately, markets don't sit still. You can actually see that already markets are starting to price this in and take note of it. So if you just think about bonds, this is essentially South Africa's 10-year bond. Back in 2023, when we all thought the national grid was going to go down and we were buying generators and lights and candles and everything that we could get our hands on for load shedding, bonds were trading at 12.5%. Longer-term bonds, 20 or 30-year bonds, were trading well over 14%. They did come down a bit last year as load shedding improved. They weakened again on Liberation Day, but you can see what's happened in the last 6 months. And this is really a combination of quite a lot of factors. It's a combination of the fact that there's improvement in the budget, but it's essentially also becoming a slightly self-fulfilling virtuous cycle, because as bond prices rally, it's also because of the tax revenues that government has collected extra. So that's where I said government is now borrowing less every day. So there's a supply and demand issue. Government isn't borrowing as much money as they used to. But also, if you think about it, I'm just going to use an equity example quickly. If a company wants to raise R1 million and the share price is at 50 Rand a share, then you have to issue 20,000 shares to raise that R1 million. But if your share price is 100 Rand a share, then you only have to issue 10,000 shares to raise the same amount of money. And that's exactly what's happening to government at the moment. Bond yields have strengthened significantly. 10-year bonds are now at 8.3%. They were at 11% earlier this year, and that's almost 3% difference in the space of 6 months. So when government is now issuing that 3.5 billion rand every week, they are issuing far less bonds to raise the same amount of money than they had to do last year or even earlier this year. And that is actually becoming a self-fulfilling virtuous cycle for government, because they're issuing less debt, therefore their interest payments are less, and therefore all the numbers that I showed you on a couple of slides ago start to get better, because government had projected that they would need to issue 4 billion rand of bonds at X interest rate. Now they're issuing 3.5 billion rands of bonds a week at Y interest rate, and that makes a massive difference. And you can see how the bond market has reacted. The same on listed property. It's a very positive story for property. It's been another great year for property. If you just think of property really benefits in two ways. First of all, property companies have a lot of debt because they go and buy big properties and they finance some of it through the banks or the bond market. So first of all, as interest rates fall, they have to pay less interest on all their debt, and so that means there's more money for shareholders. And secondly, interest rates are one of the inputs into how you value your properties on the other side. So as your interest rates come down, your property valuations go up, and that then encourages further growth. So you can see just how listed properties benefited. And I've just used the banks as an example at the end there. Banks is really a South African sector. It relies on the SA economy. It hasn't been the easiest sector. Banks have had to sort of struggle their way through. There hasn't been a lot of credit growth. People are not borrowing money at the moment. But that chart doesn't look too bad, does it? What I haven't shown you is the 5 years before 2020, when banks were actually significantly higher than that. And so banks have rallied, but really the opportunity in the market, and I suppose where the market's been a little bit more skeptical, is in pricing some of the benefit of lower inflation targeting and lower interest rates and potentially higher growth into some of the mainstream equity sectors. So it's come through in bonds and property, and this is the first leg of that journey. I think there's still plenty of opportunity left in ordinary equities to benefit from this trend. So if we just put it all together, we mustn't forget that the budget was on Wednesday, I think it was 3 weeks ago now. On that Friday night, S&P upgraded our credit rating. Now, they haven't upgraded our credit rating since 2005. This was the last time they upgraded us. They've downgraded us plenty of times. They were very quick to do that. But the last time they actually upgraded us, had something good to say about South Africa, was back in 2005. Now, the green line is investment grade. We're not at investment grade yet. We're still 2 notches below investment grade. But the point is that we've been removed from the grey list, and we've had a credit rating upgrade, and S&P has still kept the outlook as positive, which essentially means that the next time they review us, it's likely that they will upgrade us again, because otherwise you would put us on a neutral watch. But they've actually kept us on a positive watch, which almost means that we should expect another upgrade in 6 or 9 or 12 months' time. So that's very positive news. But really, if we just put it all together, there's no drag from mining and agriculture, or we don't think there's going to be a big drag on those sectors. In fact, we actually think they're going to contribute positively to GDP next year. There is a gradual recovery in fixed investment coming. We've seen it in the GDP from this week. There's so much more that has to happen in this sector. We had a long discussion about it at this morning's session, and it is one of the really weak areas. But in order to unleash the private sector and for the private sector to invest, you need all these other things to fall in place. But we have a stable and stronger exchange rate. I think the exchange rate was below 17 rand to the dollar this afternoon. That is helping to contain our inflation rate. If we had an exchange rate of 20 rand to the dollar, petrol prices would be so much higher, imported things would be so much more expensive. And so our stronger exchange rate is definitely helping to contain this inflation rate, and it's helping the Reserve Bank to build that credibility that we're moving to a lower target. Obviously, lower interest rates. When the Reserve Bank cut interest rates last week or the week before now, one of the messages was, we're going to implement a lower inflation target, and the prize or the reward is lower interest rates. So work with us here, because if we get it right, then everybody's going to benefit from lower interest rates. And the Reserve Bank was keen to point that out. And as I say, all this really feeds through to improving confidence. We all know, we've said this so many times, that I suppose the foundation stone of economics is confidence. And we all make decisions based on our own personal circumstances and how confident we are feeling about the future and whether we are prepared to take risks or not. And all these things that are basically falling into place are building confidence. So we had business confidence released yesterday. There was a very nice uptick of that. One swallow doesn't make a summer. But I'm going to get shouted down here, but I'm going to ask for a little bit of leeway from my eldest son in the back row there. But it's a little bit like teaching him how to drive. Our economy has been a little bit like teaching him how to drive over the last couple of years. We start off, we're going along, and as soon as we try and get some momentum in this economy, change into second gear, we stall. And you take a deep breath, and you be patient, and you say, right, let's start again. And off we go. And every time we try and change gear, we stall. This is the first time, I think, from a financial markets point of view, that the market can see that actually we're about to change into second gear without stalling. It's really the first time there's credible, tangible evidence that government's finances are improving, that they've turned the corner, that some of the pragmatism from the GNU is really coming through, and it's really something to be celebrated. So I don't think we're standing here saying that we're in fifth gear. We're certainly not. But in order to get to fifth gear, we have to first get to second gear. And I think that's where we really sit today, is actually on the cusp of second gear, which is super exciting because we haven't been there for a very long time. So my last two slides, as always, are just essentially the themes that we have in our portfolios. I'm actually not going to spend very much time on these slides because they haven't changed since we last did the presentation. It doesn't mean to say that we're not working hard for you in the background and looking at ideas and opportunities all the time, but it just means that when we did our homework on all these themes, we did our homework properly, and they haven't changed in the last 3 months, and that's probably a good thing because we shouldn't be trading your portfolios every couple of months. But it's essentially the same on the offshore side. We still like various different themes around data centers. I think I must say on the offshore side, I think the market's getting a little bit skeptical about AI, the amount of money that's been pushed into AI, whether all that money is going to generate a return, and some of the sort of essentially round tripping. So OpenAI is sort of buying chips from NVIDIA, and NVIDIA is investing in OpenAI, and all these companies are almost supporting each other, and the money is kind of going around in a big circle. And I think the market's just getting a little bit skeptical. I don't really think the US is going into recession. There is some conflicting data coming out of America, but I don't think it's really going into recession. And so there's always opportunity overseas, and we'll always find opportunities overseas. But actually, we think there's plenty of opportunity locally, and there's actually a once-off opportunity locally to benefit from a structural change that doesn't happen very often. So that's really my story. I'm very happy to answer any questions that there are. I don't know if you can answer or ask questions online, but otherwise you can always email us, and we will get back to you when we're back in the office. As always, for everybody that's here, it's the end of the year, and we have a few little hampers just to draw to say thank you for all your support. I'm sorry that doesn't extend to the online audience. It's for those present only. But let me take some questions first, and then we'll do the draw afterwards. Any questions? Oh, well done. No, I don't think we place a high probability on that. I think, I think that Cyril has more support than it sometimes comes across. And yes, I think one of the risks for us is going into the end of 2026 and into 2027 when the ANC next have their elective conference and everybody starts jostling for position. But I think we're a little bit early for that, and I think Cyril's got enough support at the moment that things will continue as is. But as we get to the end of next year and we start to, obviously, every party in the GNU starts to campaign for local government elections, which will either be November, December, January in 12 months' time, then we could start to see a little bit more sort of tension, I think. But I think for the moment we're fine. I hope that doesn't come back to haunt me, that comment. Yes, Nigel. Yeah, sure. I think we'll probably be here all night trying to answer that question. No, it's a good question, and I think it's a valid question. Listen, I don't think anybody understands necessarily where AI is going to end up or what the impact is going to be. Myself and Billy, I think our whole investment team have read quite a lot of books and on this topic, and some of them are frightening and apocalypse type sort of scenarios. And I don't think anybody really understands where it's going. I think the challenge is that companies are driving it, not governments. And so, whether every company has got a moral code or a responsible code, I don't think so. But some have, some haven't. So I think in short answer, I don't think anybody really knows ultimately where it's going to end up. All I can say is that, I think AI really, for us, a lot of it's really just about harnessing data and capturing data and sifting through massive amounts of data, obviously using that data to then predict outcomes and things like that, but driving those sort of efficiencies. I'm sure there are going to be job losses, but there will be jobs created in other industries, at the same time in implementing AI or other things. So I think the whole world is nervous about AI, Nigel, quite honestly, and we're nervous about it. And I think I'm actually not even sure where it's going to end up. Billy might have a different comment on it, but we can talk about that later. But I think your apprehension is well-founded. I think the whole world is apprehensive, quite honestly, because it's just moving so quickly. I mean, every 2 or 3 months, another model's come out. The technology gets sort of better. And I don't know if you ever remember that movie in the 80s, Terminator, where the world was destroyed because the computers finally got too clever and realized what was going on. I think essentially maybe that's not as science fiction-y as it once sounded. I mean, to be dramatic, I think the whole world is concerned about that. And it also is I think Billy shared something with me earlier just from L'Oreal. Obviously, L'Oreal is a huge makeup business and beauty business. And they can just run through different permutations of lipstick, for example, and define colors, at a fraction of the cost and the time that it used to take them. So AI can run through 5,000 different color palettes and decide which ones, whereas they would have had to do each one individually and test it and things, and now it can be done in a fraction of a time. So there's lots of benefits, but there's also a huge amount of risk. Watch this space, I think, is all I can say. Sorry. We'll be here to hold your hand. or yours, or you ours, as the case may be. Any other questions? Right, I'm just going to ask, I'll ask Harry, who's writing his learner's license tomorrow, so maybe we will get into second gear. You can come up and do the draw, young man. He's been very malaligned, because actually, what I haven't really told you is that he's only ever driven an automatic car and he hasn't stalled once, but it's because he can't. Right. Close your eyes. That's great. Right. So we have 3 hampers tonight, as we always do at Christmas time. And so the third hamper, the first name to be drawn out is for the smallest hamper. So it's lovely to have your name drawn out, but if you have a choice, it would be the last hamper. But the first hamper goes to Roger Foster. Congratulations, Roger. Okay. Okay, next one. Warren Slaughter. Where's Warren? I haven't seen. Ah, there you are, Warren. Congratulations. You can go and give it to him. Congratulations, Warren. Okay, last one, Harry. You can read it better than I can. Dave Goddard. Where are you, Dave? Where are you sitting? Ah, there you are. Right, that'll keep you, just make sure you book a dentist appointment for the new year too. And don't hold us responsible for that. Thank you, Harry. So thank you very much, everybody. It's lovely to have everybody here. We really appreciate you coming out. Let's hope we get a little bit of sunshine over the Christmas period. Enjoy your Christmas, enjoy your holidays, travel safely if you are traveling, and we look forward to sharing all our insights with you again next year. But just a happy Christmas to everybody. Thank you.